you think about all the negative news that we're hearing, and it would be shocking if I told you that we were going to enter into a bull market, but guess what just happened, Derek?
Right. The S&P is now more than 20% off that October low following the NASDAQ. Small caps continue to lag behind, although they've been playing catch up very, very aggressively in the last couple of weeks.
And you think about what's happening from the October low to where we are today. You know, the backdrop, of course, has been the Federal Reserve, and we're going to get to that. But underneath the market, though, there's a lot going on. We certainly talked about the big stocks pulling everyone else along, but people forget about sometimes what's happening with small caps.
Right. I mean, the small cap index is at a relative low in terms of valuation that we really haven't seen since 2001. So small caps have basically been thrown out with the bathwater. And what we're seeing is companies in the small cap arena that actually make money are starting to trade very well. And I guess that's part and parcel because, we had the speculation of last year. We had a lot of companies come public that were trading at nosebleed valuations, not making money, and that held the small cap indexes down. But recently, the small caps, which are more cyclical in nature and also contain a lot of banks, have bounced dramatically.
And you look at the valuations in small caps, and a lot of that is compelling. So I'm really not surprised that that's starting to attract a bid, as they like to say, in the markets. And we look around the other parts of the equities markets, and a lot of times, we get myopic just about what's happening domestically, but internationally, we're starting to keep an eye on Japan.
Right. The Japanese market has been trading better. It's been a perpetual underweight on the part of international investors, lousy demographics, issues related to the age of the population and so on that have basically curtailed investor interest. But recently, the Japanese market has been leading on the upside while China continues to languish.
And we're going to watch that and continue as one of the themes going forward. But flipping from the equity side to the fixed income side, I'm getting lots of questions, Derek, about rates of return on short-term treasuries.
Right. I mean, when I look at a T-bill trading at over 5%, say for a 6-month treasury bill, and I think about with the S&P trading at 4,300 at roughly 20 times forward earnings, it would seem to me that that's a reasonable speculation to reduce a little bit of exposure on this recent stock market strength and give yourself some portfolio stability by getting a T-bill for 6 months, because there's a lot that could happen this summer. There are all sorts of risks out there. We'll go through them in a little bit. And it's just a good way to manage risk as you continue to try to build for your retirement.
And of course, we're talking to those do-it-yourselfers, but there's lots of people out there that aren't do-it-yourselfers. You're working with an advisor. Perhaps it's an a set-it-and-forget-it philosophy, but there's no doubt that keeping your finger on the pulse right now is very important. And let me just talk about yields for a second. Part and parcel of this conversation is the Fed meeting next week. All eyes will be on what they say.
Right. The expectation is they're going to pause and talk about the data going forward. But the market believes there's one more hike in store for us. If it doesn't come in June, they think it might come in July with a 75% probability. But again, that depends on what CPI is next week. It's possible we could see a 3 handle, which I'm sure would excite people. But as Todd Voigt, our chief investment strategist, had mentioned any number of times, that's a base effect, that we're going against high inflation readings from a year ago. And though that base effect becomes less onerous going forward, so inflation could very easily echo and start to perk up at the end of the summer.
And of course, folks, don't anchor on that idea that 75% of the betting population thinks that we're going to get a change in interest rates, because that may not happen. And we've seen dramatic moves in those betting odds overnight.
That's true. We certainly have. I mean, right now the Atlanta Fed is looking at Q2 GDP growth of 2%, so no recession in the second quarter. And many of those that thought earnings were going to fall off a cliff in the second half as the economy fell into a recession are basically having to lick their wounds and buy.
And lastly, speaking of recessions, we saw what happened with the EU this past week.
Right. The EU actually is in a recession. We saw the German GDP was down 0.5% in the fourth quarter, also down 0.3% in the most recent quarter. And the Eurozone actually faces a much more onerous inflationary task than we do. They've been negatively affected by the Russia-Ukraine war, and that's why their central bank continues to tighten as they did recently.
And of course, that is really the reason why we really want to go through these portfolios and make sure that they are aligned with what's happening in the world right now. You can get that done pretty easily